Charandeep Singh, founder and managing director at Girik Capital, as well as Varun Daga, who's a co-founder and fund manager. Thanks so much, gentlemen, for taking time out and joining in. It's expiry, and then, of course, the big budget event coming up next week, and we're in the thick of earnings season. But, looking at the screen, Charandeep, it's a little bit disconcerting purely because of the fact that as we were talking this morning, the FIIs are on a relentless selling spree, whatever factors you attribute that to. Do you think that that's going to be a concern for us for quite some time, or do you think that the budget could be, that key trigger that could change the positioning?
Yeah. Good morning, Avan, and thanks for having us on the show this morning. I think there's 2 points that come to my mind when you mention the FI selling. See, it's very hard to pinpoint the exact factors, but one thing that does come to our mind is that interest rates have gone up globally. They've of course gone up a little bit in India. We don't here sitting in India realize the kind of damage there has been in growth stocks, high growth stocks and tech stocks globally. Portfolios are heavily damaged and people are hurting. And now, after many, many years in the West, you can, for example, buy Microsoft investment grade bonds at 5%, and you can buy high yield bonds at 8, 9, 10%, right? Which is far higher than Indian high yield bonds yield. So it's a huge anomaly. Now, imagine an FI sitting making allocation decisions and saying, what do I choose? It's a tough choice. You're spoiled for choices. It's a buyer's market, both on the equity side and on the debt side. India, on the other hand, also has the headwind of high multiples compared to its peers, right? But what's in favor, and we believe really in favor, is that you have very good earnings visibility, as is well known, and probably one of the isolated growing markets in the world with a great outlook. So I think that there are pros and cons, but unfortunately, FIs don't think the way we do sitting in India. They've got their own agendas and their own macro factors to look at.
Okay, so now when we've actually established that, can I also ask you what are the kind of big changes that we can expect in your portfolio, the changes that you have already made in anticipation?
I'm happy to take that question. Well, look, I think there's been a strong realization over the last 15 months at Girik's end, and I think the market's also adjusting to this, is that you had a lot of high growth, well, not necessarily high growth, but a very high multiple stocks that have done very well in the last 5, 10 years. A lot of the consumer pack, a lot of the retail lenders, anything to do with the consumer had gotten very expensive. And you're seeing a bit of deflation of that trade right now. So I think one has to be very cautious in growth at any price, buy at any price, high growth companies, which used to trade at very high multiples, where the growth isn't actually that high. So whereas we are proponents of high growth style of investing, we believe even that has a price. The biggest driver of equity market returns is ultimately a low entry multiple when I'm talking at a stock specific level. So very important that you get the growth right, but you get the multiple right. I can tell you that we are seeing more opportunities than before. The IPO market has come to some level of normalcy. IPOs are now worth looking at again because they're not coming at crazy multiples. They're starting to come at more reasonable, fair multiples. Just because the overhang in the growth market, given the global dislocation, the opportunities are opening up. We made tremendous changes to our portfolios in the last 12 to 18 months. One more theme I think that I will leave you with is that there is a lot of sectors that were ignored over many years. Your capex oriented, construction oriented, manufacturing oriented, where there's a bit of a renaissance going on in India. Because they've been ignored for so long, the market caps are not very large compared to the size of the earnings growth that can come, assuming that manufacturing as a sector plays out well in India. So that's where we are leaning, and these are the sort of trends we are seeing.
I'm just looking at the declared portfolio, what we have. 5-star, it's an IPO. I would consider Zomato still, it's a recent listing, about a year plus. You've added Landmark Car, which is not even 3 months old, and Shirma SGX, which is about a year old. So I can see there are 4 IPOs which are part of your portfolio. Any reason why these 4 stocks have made it to your portfolio?
Yeah, I could take that. Hi, Nikunj. Very happy New Year to you and the entire ET Now team. So, we've always been very, very excited to look at IPOs. We think IPOs can deliver massive value, uh, provided they've bought at reasonable multiples and the growth is intact. Uh, you know, we even in the past, many times IPOs are not well understood when they list, and over time, people understand them, and allocations and money flow do start coming in. So, what we've learned is that the first few years after a company is IPOing are probably one of the best times for their stock prices and businesses, even for their businesses' growth. So, and each of these companies are on in different sectors, but we feel that the growth would be pretty solid, run by good promoters, good management, and we generally are always in the lookout for good IPOs.
Be specific here. What is that you like about Landmark? What is that you like about Five Star? Why are these two stocks are part of your portfolio? Five Star, based on what the industry average is, based on price to book, not really cheap. Landmark, niche, but it's a business which some would say is difficult to value.
Yeah, that's true. If you look at Landmark, I don't think many people have understood that business. What we liked was the service part of it. I think one theme which we really felt was interesting in the Indian auto market is that the whole industry is moving towards higher end auto cars. So people want to buy more expensive cars rather than the cheap ones. We've seen that with many companies like SUVs are getting sold more than the entry level cars, and I think Landmark plays in that bracket, where it's selling more expensive cars. It's not in the entry level cars. All the dealership it has is cars above 10 lakhs. So one is that. The other is that there is a big element of service revenue, which we felt is very, very sticky, and we felt it's a long tail. One could play it for the next 5-10 years. And again, one thing which we are very, very cautious about in these markets is the starting multiple. The starting multiple needs to be in your favor, and we felt it was in our favor here. And the other one is Five Star. Yes, Five Star is probably not the cheapest, but you know, I think we feel that the growth is very exciting, the history is very good, and we'll see how it plays out. But I think they've done a great job to come where they are through COVID, and
Tell you what,
we're
just hang in
excited
there.
about.
We'll open the market, just establish the first initial rates, and I'll promise, it's going to be a very short. We'll come back to you right the minute the first rates are settled. 20 seconds to go. As you walk into trade this morning, the rupee strength, I think, is something which cannot be ignored. Remember, if rupee is strengthening, and if you are a global investor, it's like a double advantage for you. So historically, when currencies have always appreciated, global investors, they tend to come back because that is an endorsement of good macro things coming back. But are we in for a good day? Well, nothing over the weekend came out which warrants a serious relook in terms of a Reliance numbers or Kotak or for that matter ICICI Bank. But I'm just going to mark the numbers here. Even the rupee is turning out to be the first big headline this Monday morning. 51 points higher for the Nifty. Let's start marking some newsmakers. Reliance Industries, they came out with numbers in line with estimates. Nothing that warrants a big upgrade or a downgrade, and the market reaction is absolutely muted. Second is ICICI Bank. Deposit growth is lagging the credit growth. Could that hit the NIMs going forward? That's the worry. Kotak, we were discussing that out of the lot, if you have to pick and choose within the large cap, it is Kotak where the numbers have been good across the beat. Now, so I will not be surprised if the stock during the course of the day gains more weight, and it is gaining weight with each passing second. Let's look at Yes Bank, IDFC Bank, Ultratech Cement. Yes Bank, still work in progress, 8% lower for Yes Bank, went up to 24-25, has come down to 18. IDFC Bank has a long way to go given the kind of growth that they are demonstrating. That's my sense. And then Ultratech Cement, they also came out with numbers. I mean, cement is not the sector which everybody is really aiming to own in the short term. But in terms of price action, nothing whatsoever. So excepting Kotak Mahindra Bank and IDFC, there is no large result reaction at least I can capture on my screen.
It's quite intriguing that Yes Bank has fallen the way it has, considering the asset quality has actually improved on a sequential basis, and the NIMs as well have come in lower at 2.5% versus 2.6 on a sequential basis. RBL Bank as well came out with its numbers. NIMs have come in at a 10-quarter high of 4.74%, and slippage to NP ratio has come in at 8 to 9 quarter lows. Couple of other earnings, you've got a JSW Steel, Ultratech Cement like Nikunj highlighted. Adani Enterprises, of course, one of their subsidiaries is now in a defense joint venture with Aramco JSC in a 56-44 ratio. So Adani Enterprises continues to be a stock in focus. SBI Life, the numbers are disappointing there. Both the VNB as well as VNB margin and profits have come in below estimates. LTI Mindtree as well, the constant currency revenue growth and margins below that what the street was expecting. Bandhan Bank also came out with its numbers. Both the profit as well as the NII are below what the street was anticipating. JSW Energy, again a disappointment there. Similar is the case with Petronet LNG, or for that matter even Oberoi Realty, wherein the Q3 booking value is now down 67% and the area booked is down 65% on a year-on-year basis. Shakti Pumps, Tanla Platforms, Make Money Organics, these are a couple of other smaller ones which came out with their numbers. But yes, it's a truncated week this time around. 26 January, remember, is a trading off. You've got expiry to deal with, and then of course the countdown to the union budget.
Okay. Let's connect with Charanjit and Varun, but I just want to establish Yes Bank before we go there. Of course, the relief which has been granted to the bond holders there in terms of the A1, bond holding structure is something which is having an impact on the Yes Bank stock today. Apart from numbers, that's the other talking point. That the news, of course, came on Friday after the market hour. Yes Bank has 6 weeks before they go back and challenge this entire decision of High Court. But that in the near term is something which will be an overhang for a stock which normally, it's a stock which is dominated by HNI investors and by retail guys, not so much so in terms of institutional activity. Varun, I think you were making a point on 5-star. It's expensive, but yet you like it. I mean, isn't that against the grain? Because Charanjit just said that you want to buy stocks when they're cheap. So why are you confident of making money in 5-star even though it is not cheap?
Yes, I think valid point, and that's why we start with a very small allocation, and when we see how it goes. But I think the general philosophy here is that we feel the growth will be very very strong, and we still need to see how it plays out. But we like the execution, we like the management, the way they came through COVID was very good. But yes, we are very cautious of starting high multiples, because we can see that market's not rewarding uh, growth at any multiple. So one needs to be careful for sure.
Right. Charanjit, I also see that you're sitting on almost 18% cash levels. Is that a conscious call? Is it just for scouting newer opportunities, or are you also sort of a little wary about what the budget is going to do on LTCG?
Yeah, no, that's not the case for us. I don't think it's as high as 18%. It may be maybe less than that. But in general, we're not market timers as such. And, we're opportunistic as to the stocks we have. And if entry points emerge in our stock, or if we have a reason to increase allocation in something or find something new, we'll deploy the cash. So we are always looking to be fully deployed. We're not trying to time based on events that we don't do well and we don't try to do.
Yeah, I stand corrected there. 12.88%, so about 13% cash levels. Yeah, Nikunj was saying.
That's the last declared portfolio.
Yeah.
Okay, I'm going to ask both Varun and Sandeep in terms of where their views are on the LTCG and STCG. So starting with you, Charandeep, there are two options here. One, there is no change in the LTCG and the STG structure. What happens to the market in that scenario? Option number two, the rate of LTCG and STCG, they are at par with each other. What happens to the market in scenario number three? Scenario number two and scenario number three is that the tenure is increased and rates are not increased. What happens in that? So Charandeep, the three scenarios.
Okay, so I can tell you, Nikunj, that if there's any tinkering which is not favorable, will hurt the market sentiment. Because more than tinkering with the taxes, it's very important once you set up a tax regime which is not more than 4 years old to let it run its course. I don't think that it would be taken very well by the market at all. Any tinkering which is adverse, be it increasing the long-term tenor or making long-term and short-term at par. It's very important to have consistency in tax regime. And I also hope that this stays its course, the current tax regime, because you've already tinkered with it once in the last 4 5 years. So I think that, yes, I would be in the camp and favor. And, one might think it's self-serving, but that's not the case. I would just say be consistent. And consistency is ultimately, you're a long-term winner. You show the world that you have a stable tax regime. It increases the confidence of investors manifold.
Warren, globally, what is the tax structure like? And in India, I'm asking a very basic question. If you have to compare the Indian tax structure for capital markets, is it higher, is it lower?
India is, of course, at a good tax structure. It is lower than many global markets. But, also one needs to understand that, we need more and more people to get included in the capital markets, right? So if you compare India versus many other economies, we are still at what 7 odd percent, where many of the developed economies are more than 50%. So I think having a favorable tax structure will encourage more and more people to come into the markets, and it's very important for them to get included into the formal uh, way of investing and getting into mutual funds, PMSs, get included in the market basically, and stay invested for long periods of time. So governments will and taxation plays a very very important role for that. And I think we've already increased it once, and keeping it at this level will really really help many of the retailers to come in and participants to join the market. And we are already seeing that, if you see the last 3 years, 3 4 years, thanks to digital transformation, uh, new brokerages coming in, I think we've really seen a lot of people get included. SIPs become so large. I mean, we're moving in the right direction, so why would you play around with that?
That, of course, has been one of the big thinkings, right? That if you've got one of the best performing stock markets on this planet, why would you disrupt it by just changing the capital gains tax? And we do see those news reports every year ahead of union budget. So this one, of course, not being any different. But before we let you gentlemen go, whichever one of you want to take this, the big ideas always before a budget is what? Look at home loans, that there will be an infrastructure play. Are you folks expecting anything different at all?
I'm happy to take that. I think it'll be a similar budget to last year's, wherein the government has emphasized spending on infrastructure. I think that spend on infrastructure will continue because that train has left the station. So I think emphasis on infrastructure development and manufacturing. I think these are the things that should continue to get benefit in the coming years, especially now.
Okay, gentlemen, we're going to leave it at that. Thank you, both of you, for being live with us this Monday morning, taking us through where your head is at when we look at the markets and, of course, how to make money. Always a pleasure talking to both of you.
Thank you.
Thank you.